Hello, this is Jordan, and this is your precious metals video market update. This is being recorded on the early afternoon of Thursday, March 24th, 2016. Starting off, let's take a look at the daily candlestick charts of the miners. We have GDXJ on top, GDX below, and the miners could be, well, I shouldn't say could be, but they're in a consolidation right now. Call it a consolidation or a correction. And essentially, we have two support levels. The main support, the initial support, starting with GDXJ, that's at around 26, closed about $1 above that today. And that first level for GDX is at 19. So sticking with GDX, if it breaks below 19, that projects down to a target of 17. That's strong support. That's the 50% retracement. I'm showing the 50-day moving average at the bottom, and that looks like it's going to coincide with the mid-17s. There's also support there. And I'm not showing the 400-day moving average on that lower chart, but I do believe it's in the mid-17s. So if GDX closes below 19, look for a low in the mid-17s, maybe low 17s, realistic worst case. Now back up to GDXJ. GDXJ has been stronger than GDX. It's not as close to breaking that initial support, which is at 26, as we said. But the confluence of support, I mean, we're looking at the moving averages. The 50-day is at 23.5, but that's rising. That's going to get to 24 or the low 24s soon. And the 400-day moving average, which if you've followed my work and you've watched my videos, you know how important that is and how it's contained every bear market rally over the last 4 years in the miners. So it makes sense that the miners have gone above it, and now we're going to look for, during this consolidation slash correction, look for the miners to retest that moving average and have it be support. And so that 400-day moving average for GDXJ is at 24.44, and there's also lateral support at 24. So there's a real strong confluence of support at 24 or slightly above it in the mid 24s. The 50% retracement is at 23. I don't recall where the 38% retracement is, but if I just calculate it quickly, that could be 24 or probably, let's see, it probably in the low to mid 24s would be the 38% retracement. So there's a strong confluence of support there in the low to mid 24s. And if we see GDXJ close below 26, look for a low or at that confluence of support in the low to mid 24s. And the same goes for GDX in the mid 17s or possibly a little bit lower. Now, sticking with, I just wanted to see, because I forgot the charts I'd put on here, but this is my top 15 index. This is a weekly candlestick chart. I did not update it for today's action. It closed at 172 yesterday. It's probably up a little bit today, but it doesn't really change the candlestick that much for this week, which was a short week. So the index over the last 3 weeks has really been consolidating from about 155 to 180. Over the last week or so, it did have a quick pullback from about 180 or 178 down to 155. It had a quick 15% correction, and then last week it closed the week very strongly at, I believe, 181, which was the highest close in nearly 3 years, in just about 3 years. The median market cap of this index is about $420 million US, just to give you a sense of what kind of stocks are in this index. It's not my 15 favorite stocks, but most of the stocks in there are companies I own and I really like. But essentially what we see here is this index is really consolidating from about 155 to 180. So again, today probably closed at, let's say, 175 or 176. Something like that, I'm guessing. So it wouldn't surprise me if it corrected 10% down to 160 or maybe a little bit below. That would still be in the bullish framework. And so what we see that's happened with this index starting really small. We can see that it was consolidating for most of 2015 and then into early 2016. I remember in January I was worried this was going to drop down to 100 and test 90, and then it exploded higher up to resistance. It just kept going, very strong gains. And so that happens after you have a long consolidation where something breaks out and then it really runs. And so the index has come up to major resistance at 180, and as I said, it's consolidating from about 155 to 180. I would not be surprised if the index just continued to consolidate in that range for the next couple weeks, or even if it breaks above 180, it could break above and then come back down and trade around 180. Sometimes you get that kind of a move where you get a breakout and then the retest takes a while and then it goes a lot higher. But generally, I believe we're in a consolidation here. But if we're looking out over the next 2, 3, 4, 5, 6 months, this is a really, really bullish setup here, because when this index breaks above 180 for good, it has a measured upside target of about 265 to 270, and that intersects, or I should say it coincides perfectly with you go back to 2012 and we had that double bottom, and then where the market really started to fall off in early 2013. So there's a lot of memory there. So this is about 45% to 50% upside potential. And obviously, if that comes to pass, that would coincide with the next big move higher in the sector. But this is just to show you what potentially lies ahead and why it can be dangerous to try and buy. I'm going to try and sell at the top and buy when it corrects. Like I've been saying, just have your list of the stocks you like and you want to buy, and just when they correct 15 or 20%, take advantage of that. Don't try and wait for something to go down 30 or 40%. It's probably not going to happen. You're risking too much there. But if you buy something that's 10, 15, or 20% off its recent high, remember these juniors are very volatile stocks. If you do that, that's going to be a solid entry point in the context of what's developing here. And next, this is the Huey bull analog chart. We compare the current rebound in the Huey to that of 2000 and 2008. The current is in black. I've updated that today, and it's more closely following the 2008 rebound. But what's interesting is if you look at that rebound, right away I think it had a 25% decline. Then it had a 20%, and then I think another 23%, which is a month or two in the future compared to where we are now. So up to this point, the Huey has not corrected more than, well, actually I'm not sure, but what I should say is GDX has not corrected more than 10% up through this point. And if you compare that to GDX in 2008, GDX, when it got to this point, had a 20% correction. So I mentioned that a couple weeks ago, that history argues that we could have a 20% correction, and if we break those initial supports that we noted a couple slides back, then that's likely to happen. But you can see, 2008 was a fantastic move, but there were so many corrections along the way. So again, my analysis of this, and my actionable analysis of what to do going forward, is the trend's going higher, it's going a lot higher, but there's a lot of corrections along the way. So number one, you want to buy and hold, and number two, you want to try and buy weakness, as I said. And we're at a period of weakness right now, and it's possible that we could see more weakness, and if it continues to break lower, like I noted a couple slides back, you want to jump on that weakness, because I don't think it's going to last that long. Now, here we have a chart that's in my book, and I could do a whole video on this, but this is a chart of gold, and in the middle we have the real Fed funds rate, and at the bottom we have the real 5-year yield. And as we've said for so long, the real fundamental driver for gold and precious metals is declining real rates or negative real rates. And here we've highlighted the 4 worst bear markets. And why were they the worst 4 bear markets? Well, because in most cases, real rates increased strongly. And you go back to the mid to late 90s, real rates were already positive, but then they got really high. The real Fed funds rate was 4%. The real 5-year yield was 4%. There was an increase there, 96, 97, 98. Uh, whereas the other three worst bears, they were during a secular bull market for gold, and so real rates went from negative to zero or slightly positive. And it's tough to see in this video, but let's start with the real 5-year yield. That peaked at the end of 2014 or early 2015. It peaked just below 2%, and now it's at about 0.3%. So the fact that the real rate there has declined, that's bullish for gold, even though it's not negative yet. That's bullish because it's declining, and you're earning less interest if you hold that security, so that's more favorable for gold. And the real Fed funds rate, I mean, that got up to, it's very difficult to see, but that went above zero, became slightly positive at the end of 14 and early 15. Well, it's not updated in my chart, unfortunately, so I forget what it's at right now. But 2 months ago, it was at minus 0.42%. I do think that that could be close to minus 1% right now. I'm sorry that did not update yet with my data. But the point of this chart is to show you, we've had this huge move in gold, and the concern is, well, I'm about to get whipsawed again. We're going to have we're still in a bear market. There's going to be a huge correction, and look, none of us can predict the future. We don't know what's going to happen, but if we look at this move and we look at what it is being driven by, we can see that in this chart that there's been a clear change in the last couple quarters where real interest rates, they're no longer rising, they're no longer above zero, they're declining, and they're in negative territory. So we have that fundamental support. There's a strong fundamental backdrop for the action that we've seen in precious metals that was not existent in 2014, 2013. So that's something we have to keep in mind, that there is fundamental support so far. And if you haven't already, go to thedailygold.com/book and you can get a free copy of my book. I'm also going to be doing a new report kind of talking about, what do you do after there's a major bottom in a sector. And so I'll have a lot of my work and new charts in that. I don't know when I'll be giving that away. It could be a couple weeks, but another reason to get the book, get on my email list. And if you want to follow more of my work, you can go to thedailygold.com, sign up for my newsletter. You get the book, you'll get future reports, you'll get some samples of my premium work. And if you have any comments, questions, or concerns, feel free to send me an email, jordan@thedailygold.com. That's all for now. Thank you very much for listening and watching, and I hope you all enjoy the long weekend.